What's the difference between index funds, mutual funds, and ETFs? Each of these investment vehicles are distinct yet similar, each offering unique advantages and disadvantages. As a lawyer focused on helping families create generational wealth, a big aspect of my job is helping people pass on their investment portfolios, and that involves me meeting with and speaking with many financial advisors. In these conversations, I found myself asking more and more questions and doing research for my own investments. I discovered that a lot of my clients are confused about the options, so I want to share with you everything I've learned so that you can be more informed before making any investments of your own. So if you want to learn the difference between index funds, mutual funds, and ETFs, and which option might make the most financial sense for you, then keep watching. Let's begin with mutual funds, the oldest of the three types of funds. Mutual funds predate both index funds and ETFs, with the first known mutual fund dating back to the 1800s. These funds were established as a way for multiple investors to pool their resources and invest collectively. There are three primary benefits to investing in mutual funds. First, there's convenience. A mutual fund allows you to own a diverse array of stocks in one simple purchase. Imagine owning hundreds of different stocks through one transaction, as opposed to purchasing each one individually, saving you from making multiple transactions and paying numerous trading fees. This brings us to the second benefit, diversification. By spreading your investment across various stocks, mutual funds help you mitigate risk. Even if one stock fails, it's just a small part of your portfolio. Typically, a mutual fund holds at least 90 different stocks, offering significant diversification. That would be challenging to achieve on your own. The third advantage is professional management. With mutual funds, expert fund managers handle the stock selection, potentially enhancing their performance. Despite these advantages, mutual funds are not without drawbacks. These conveniences and diversification are appealing, but professional management often comes with high fees. Actively managed mutual funds typically charge annual fees ranging about 1% to 2% of your investments. These fees can significantly erode your potential earnings, especially if the fund's performance does not meet expectations. Moreover, even if the fund underperforms, the fees are still applied, which could end up in a situation where you end up with less money than you initially invested, while the fund managers continue to receive their fees. This dissatisfaction with high fees is what led to the creation of index funds by Jack Bogle, who introduced a new type of mutual fund aimed to offer a more cost-effective investment strategy. Unlike traditional mutual funds, index funds are passively managed. They follow a specific index, like the S&P 500, which is a snapshot of the stock market, meant to reflect its overall performance. Because these funds are not actively managed, the associated fees are much lower. For instance, the Vanguard S&P 500 Index Fund has an annual fee of just 0.04%. Essentially, all index funds are mutual funds, but not all mutual funds are index funds. If you're reviewing a fund and it tracks an index like the S&P 500, it's likely an index fund. Finally, let's discuss ETFs, or exchange-traded funds, which arrived on the scene about 15 years after the first index fund. ETFs are similar to index funds, but are tradable throughout the day, like stocks, offering greater flexibility. However, this can be a double-edged sword. The ability to trade ETFs like stocks might encourage impulsive decisions, which can be detrimental to your long-term investment strategy. For those deciding between ETFs and index funds, consider whether the ability to trade frequently is truly beneficial for your investment goals. In my experience, an ETF isn't actually the best option if you are investing for the long term, because ETFs encourage gambling-like behavior, which is the opposite of smart investing. In conclusion, while ETFs and index funds offer many similar benefits, the key difference lies in the associated behaviors it might encourage. For most investors, especially those focused on long-term gains, the simplicity and lower fees of index funds usually is the preferable choice. Index funds also offer other features like automatic reinvestment, which simplifies investing further by allowing for easy, ongoing contributions without associated fees. I hope this breakdown clarifies the distinctions and similarities between mutual funds, index funds, and ETFs. Understanding these can help you choose the right investment path based on your personal goals and preference. Remember, whatever you decide to invest in, it's important that you set up an estate plan for your investments and other assets. That's why your next step is to watch my video on wills versus trusts linked here. You'll learn more about what is right for you.